covered calls are the most popular options trading strategy. And I don't know if that's always the case. There's probably more people trading spreads in their accounts and doing things of that nature. But at the same time, even if I've got, I'm just getting started, or I've been in, or I'm trying to follow the trendy trades, and I'm, trying to follow the different strategies. I'm trying to follow new debit spread ideas. I'm trying to follow 0 data expiration spreads, things along those lines. Somewhere in my portfolio, even if it's in a different portfolio that's an IRA or retirement account, if I'm approved to trade options, I'm probably selling calls against stocks that I've had in my portfolio for years. I'm selling out of the money calls, just getting some extra, trying to replicate an extra dividend like income, maybe on a dividend aristocrat, keeping it far out of the money, maybe a 0.3 delta, 75% probability of expiring worthless, and just getting 20, 15, 30 cents a month, or maybe 10, 15 cents a week, something along those lines. So there's a large percentage that are trading covered calls. And even if it's a smaller portion of the portfolio, I have 2 or 3 covered calls open, and I have 10 spreads, you still have covered calls there. Now, where am I going with this? Well, the discussion that always comes up is, what is the best covered call? We've got multiple YouTube videos on this, and if you click on our YouTube covered call playlist here in the Learning Center under the covered call tab, let's just do that real quick. You see, which is the best covered call strike, calculating the best strike price for a covered call, why use in the money covered calls. And that's kind of where I want to start today. We're just going to go into the search very quickly. And we had some questions this week similar to that. Why use an in the money covered call? Why? I can't understand the math behind an in the money covered call. And I'm going to go to one of our default searches. I'm just going to go to the basic in the money covered call screen. And we see positions like Yeti, Peabody Energy, Tennyson, Levi Strauss. That's an interesting one. Coremedics, Delta Airlines is in there as well. Let's just stick with Yeti Holdings, of course, here. Yeti, the coolers and everything along those lines, and the sippy cups, and some small version trying to get business, market share, I should say. I'm off of Stanley, but I don't think they're going to come close. Their thing is really the coolers. Very nice coolers, fairly expensive, but very nice for the beach, for anything like that. Summer's winding down. In any case, 28 days out in time, we could buy Yeti at $35.71. I can sell a September 27.5 call for an option price midpoint of $8.50. I could probably get close to that. $8.20 bid, $8.80 ask. Yeah, I'm going to get $8.50. So I'm paying $35.71 for the stock. I'm getting $8.50 back immediately. So that's almost a 24% downside protection. What does that mean? It's just the option price divided by the underlying stock price. My net debit drops to $27.21. So I have a 24% downside protection. The stock can drop 24% almost before I'm technically losing money on the trade. But I'm giving up a lot, aren't I? I'm giving up almost $8. It's a little bit more than that. It's about $8.15, $8.20 here between $35.71 and our $27.50 strikes. More than the one I said, actually. But I'm getting compensated for that by the option price. The difference between the stock price and the strike price, that's our intrinsic value. We've gotten that, and then we're getting a little bit extra. Our return, if assigned, is only 1.1%. So for 30 days, I'd only make 1.1%, but I've got almost a 99% theoretical probability that Yeti will stay above $27.50 in the next 28 days, and I'll make that 1.1%. Let's take a look at the Yeti position. We're going to go to that more information button, and we are going to go to the profit and loss chart. It just gives us a simple graph of the position. Again, buying stock at $35.71. Selling the call, the $27.50 strike, for $8.50. Now, we could round the numbers, but let's use the actual numbers. $35.71 for the stock. And we're going to sell this $27.50 call. So $821, or $8.21, we're giving up because we're agreeing to give up shares of stock at $27.50 that we bought at $35.71. But we're getting $8.54 that, so our max profit is going to be what? 29 cents. Assuming midpoint, which I said, we know we could probably get close to that. But that's going to be 29 cents. This is the intrinsic value of our option, the difference between the strike price of the call that we're selling, of course, and the stock price. And this is the time value. This is our true profit. We're being paid for the time, 28 days, but it's so deep in the money that it's only 1.1%. As you saw, our net debit drops down to 27.21. We buy the stock here, get the $8.50 deposited in our account immediately. So we're only technically paying out 27.21. Make 29 cents against that. How do we make that? If the stock stays above 27.50, what happens? Well, this option is assigned. Our stock is delivered at 27.50 with our cost of 27.21. We make the 1.1%. We don't lose until the stock falls about 24%, that downside protection again. Also, the question is, hey, Yeti's been strong. The market's been strong today. We've got that news from Powell. We heard some favorable things. The market's starting to price in what might happen in September. Some other decent things happen. We've seen some weak earnings come out from different companies recently. We've had some good ones come out today. But why would I give up my shares of stock $8 less than I paid for it? Why would I do that? Well, I'm getting compensated for it. And as we saw, we've got that high 90% probability that Yeti will stay above 27.50. And I'll have the stock called away from me. I get assigned. It's no longer in my account. I have a 1.1% return in 28 days. You see the annualized there is 13.9%, assuming this kind of structure. I know, it's very simple. It's a simple structure. It's a simple strategy. But you look at it and you say, well, why wouldn't you just go right at the money for better bang for the buck? Let me go ahead and go back to September. I'm going to clear that one out. I'm going to buy the stock at $35.71. Now let me just sell the 35 for $1.90. All right, so now I've still got some downside protection. I've got $2 of downside protection. The stock can fall to $33.81 before I'm making money on the trade. And if it stays right where it is, if it moves up a little bit, moves down a little bit, I still make 3.5%. Okay, and it's a 46% annualized return. You're making 119 and 3.5% instead of 29 and 1.1%. Okay, that's great, but what's the difference? Well, the difference now is risk-reward tolerance, protection, and goals, as it is with any strategy. Even though we're just talking about a covered call, this applies to calendar call spreads. This applies to iron condors. What we're going to show in a moment applies to even married puts, collar trades that are protected, buying calls and buying puts, straddles and strangles, short or long, and much, much more. Because you can also say, no, I'm bullish now that I've heard this Powell news. I'm bullish now that he's leaning this way. I'm bullish on the market based on the news that come out in the economy, hopes for the end of global strife, things of that nature. So let me go ahead. I'm going to buy the stock at $35.70. But Mike, there was another call there we saw. We saw that $37.50. Let me go ahead and do that. $37.50. What's going to happen? I'm only going to like 75 cents, which means what? We're only going to have about a 2.5% downside protection on the trade. We have the potential to make 254 or 7.3% if Yeti moves up to 37.50 and we get assigned. Or even if it goes to 37, we're at a $200 profit. That's still about 6.5, 6.8%. Why wouldn't I do it this way? And again, let's just go now to the option chain. And on the PowerOptions chain, you can quickly compare. I want calls and puts now, different strikes, but I want to go to just the calls only for September expiration. On our chain, the highlighted columns that you see here, these sort of yellowish highlighted columns, this is showing you the returns you would focus on. Now, I've made some changes. I've added the annual, if unchanged, and percent midpoint time value. You can customize this any way you want to using that change columns button up here. But the main columns that I'm looking at, these shaded columns, are showing me the comparisons of risk and return of all the covered calls on the chain for Yeti. Downside protection. I'm selling the in-the-money calls. I'm getting a higher downside protection, better protection for the stock. And I'm still making a positive % return if assigned or unchanged, right? So these are the same here in an in-the-money covered call. The % if unchanged and the % if assigned are equal since we're already starting below the stock price. So again, we saw the one here at 27.50 are 1.1% return with the 24% downside protection and that high 90% probability that Yeti will stay above 27.50 in 28 days, and I'd make that 1.1%. This assumes no management. I'm going to get to that in a moment. Our at the money 35 strike, 190 midpoint, very reasonable, 180 bid, $2 ask. I'd put my entry right in at 190 with my broker. 5.3% downside protection, not bad. As we saw, 3.5% if assigned if the stock stays right where it is, with a 57. Okay, let's call it 58. Let's be nice. A 58% theoretical probability that the stock will stay above 35. And that 37.50, only a 2% downside protection. In the case of adverse markets, that 7.3% return if assigned, with only a 32% chance that Yeti will be above 37.5 in the next 28 days, and we'd make that return. Well, so now this is the comparison. Personally, in this one in Yeti, when I'm looking at, I kind of like it to be safe. I'd go with a 32.50, 10.4% downside protection. The stock can fall 10.4% before I'm losing money on the trade. 1.5% return in 28 days with an 80% probability. This is in my wheelhouse, personally. But why would I do that? Why am I giving up this cost and allowing it to be assigned? If I'm bullish on Yeti, don't I want to be up here? Well, in my opinion, if I'm bullish on Yeti long term, I'm not using a covered call. I'm doing a married put trade or some other position that has further upside. If I'm short term bullish, I might be doing a credit spread or a debit spread on Yeti. If I'm looking to hit targets where I can have a 10% downside protection on my position, making 1.5% every 28 days, reasonable annualized return with an 81% chance of making that 1.5%, I'm not married to the stock. I'm not married to Yeti long term. I'm looking for a position using the PowerOptions search that matches this criteria for a trading plan. I don't mind being assigned and being out of Yeti. And once I'm assigned on Friday, September 19th, on Monday, the 22nd, I'm going to go ahead and run my search on PowerOptions and open a new trade that has that type of criteria. I know this is basic. I know this is a basic strategy. I know this is a basic discussion. But you get those questions. Why would I use an in-the-money call? Why would I ever do that? Is because you're getting compensated for the amount that you're going in the money. The trade-off now is, what is your desired return, your desired protection, and what do you want to do? If you want to hold Yeti long term and sell out of the money calls against it, I'm not against that. But my approach, which represents about 50%, 55% of my portfolio, is when I look for long-term stocks that I think are going to move up 3 to 4%, 3 to 6% maybe in the next 20 to 40 days, and then another 4 or 5% in the following 60 to 90 days after that. That's where I use the married put techniques. I get a low risk guaranteed of 5 or 6% with the ability to sell calls and do other adjustments near term to potentially bulletproof that trade. Something short term in an adverse market. I like the stock. I'm a little bullish on it. I want to have a little upside, but I want a little bit more downside protection, this 2%. That's when I enter a long collar position. I like the trade. It's been good. It's coming out in the news. I can make a good 1.5%, 2% return. But at the same time, in 30 days, I can guarantee that I can't lose more than 3 or 4% on that trade. That's a long collar trade for me. Yeah, I might do an out-of-the-money bull put credit spread, similar risk-reward profile with an 80-85% probability, leverage position where I can lose 100% of the margin requirement, and I'm probably making 12, 13, 14% of the difference in the strike prices there, or a bull call debit spread. Shorter term, in the news, looks good, not a bigger portion of my portfolio. But it's okay to trade stocks this way with out-of-the-money covered calls. But this is what the discussion is. If you want to hold it long term, you want to think married put, standard collar, or out-of-the-money covered call. I get that. But if you're just looking for something where you can have reasonable protection 15, 20, 30 days out, I'm not expecting the stock to drop more than 7 or 8%, but if everything goes wrong, if the stock falls 10 or 12%, I've got a good downside protection. I'm hitting my targets for my trading goals, what I'm looking for an annualized return with this strategy in my portfolio, and I'm expecting that 78 to 82% of the time I'm going to be right, get assigned, and not have to manage the position. Now, of course, we all know the downfalls of covered calls. We discussed that, which is why 50% of my portfolio is in the married puts. Sure, I can make 1.5%. In this example, sure, I have a 10.2% downside protection. But something comes up in those 28 days. So my 1.5 here to our break even is 10.4. Something comes out about Yeti and it drops 25%. Well, now you got to roll down the calls, but you're not making what you've lost on the stock. You're still down 15% and you're getting what? Maybe 1.5% time premium staying out of the money and rolling down. Now, it fell 15, 20, let's say it fell 15%. I'm down 4.5%. Okay, so that's okay. I took in some premium here. I'm getting about 1% premium using out of the money calls here. It's going to take me 4 to 5 months to get back to break even, unless it continues to fall down. Now I'm losing more on the stock than I can gain on the call rights. And it's going to take me longer to get back to that break even point. And the stock suddenly snaps up, and I'm selling calls way down here in that, let's say it has a catastrophic drop. We're down $19, $18. I sell the 20 call and suddenly it gaps up to 23. Well, I'm going to get assigned at that loss. That's the flaw with the covered call. It's the structure that gets you, even with the protection of 10.4%. Of course, we talk about the reverse. Hey, I had that potential for that 7.3% if assigned with the out of the money covered call with only a 2% downside protection, and the stock falls 15 to 20%. We're down to $20, $22. This helped, but now I'm still down 17%, 18%. How long is that going to take me to get back if I'm only getting 1% of time value? You're talking about a year, year and a half without growth in the stock. Stocks fluctuate, I know. It's the structure of the trade that gets you. Okay? So I just wanted to review that because in each of these discussions I've had this week, 2 of them were about in the money covered calls. Why would I do them? I don't understand the math of in the money covered calls. You're getting compensated for the amount that you're selling below the strike, but it's an approach where you're not married to the stocks in our opinion. You're looking for that higher probability of assigned and making that return. And yes, the return might only be 1, 1.2, 1.5% for 20 or 30 days. But you've got a 75, 80, 85% probability of making that. You just want to take that return and then go back into the search the following Monday on September 22nd, looking for October series that match what default criteria you wanted. Avoiding earnings between now and expiration, certain fundamentals that we have entered there, stock in an uptrend, good broker recommendation. I'd probably look for a MACD range in mine as well. It's personal. And the basic considerations, some good implied volatility, 1% return if assigned, 8% minimum downside protection, looking for maybe some liquidity as well, because I'm just trying to cycle through that same pattern that I'm looking for positions that have that good probability of getting assigned and making me that 1.5% return with a 12, 15, maybe 20% downside protection in case something happens that is unexpected. But if I want to hold the stock long term, out of the money covered call approaches are okay too. I get it. We're speculative. It's a little more speculative out of the money selling calls, but we get it. Hey, I bought my stock at, these are really high, but I bought my stock. Let me find something that's less volatile. Lyft, here's a good one. Lyft, we'll use Lyft. 1701. It's up $1.20 today. September 18 call for 54 cents. Okay, so I'm not expecting the stock to necessarily hit 18, but if it does, I'll make a 9.3% return. I've got a 3% downside protection for 28 days. But there's only a 33% chance, based on the historical trading of the stock, that it'll be above 18 in 28 days. Tidewater is one I've actually been looking at for a Mary put of 60.83, selling you out of the money September 65 call. Same numbers, 2.1% downside protection, 9.2% return if it's above 65, but only 28% probability that I'm going to make that 9%. This is the risk reward trade-off we're talking about. The probability versus protection. But if I'm looking to hold something long term, as I said with Tidewater, I'm likely using more of a Mary put approach, following the guidelines in the blueprint. I'm buying a put that's 6 to 8 to 10 months out in time. And I'm going to look to sell calls, do other income methods, 13 different income methods we discussed in the blueprint. 4 of those 13 income methods revolve around the put, just manipulating the put option and taking advantage of the time value as the stock fluctuates in or against your favor. It is a bullish strategy as well, just like the covered call is in a sense, as is the long collar. But it comes down to your risk reward tolerance.